Welcome to the Adams Hanson and Associates Financial Library. This is one of the many short presentations that are available. This presentation will explain when, how, and why to sell an appreciated investment property using charitable planning. The first 8 items listed here are some of the reasons to consider selling. The property may not be as beneficial as it was when it was first purchased. It's more difficult to manage. The expenses of upkeep, leaving it to heirs. Not all heirs have the same idea what to do with inheritance. The income isn't keeping up with the increase in value. I will discuss this further next in Marianne's story. There may be risks associated with the property. Its depreciated benefit is used up. Is it stressful? Does it keep you up at night? The second 8 items listed here can be some of the benefits for selling. Mitigating taxes, increase income, protection from creditors and lawsuits, fostering family unity, reducing stress, and eliminating the 8 items in the prior list that was discussed. Marianne owned a commercial building in Palo Alto, California, that was left to her many years ago by her father. She received a decent income over the years, but owning it stopped making sense for several reasons. For starters, the value of the property had recently increased substantially, to the point where $245,000 plus of net income it generated was very low relative to the $12 million value the property commanded. After using some equity for lifestyle over the years, she carried forward a $2.7 million debt on the property. Since debt cannot be transferred into a charitable trust, she did a 1031 tax-free exchange into 2 separate properties, both being medical clinics. The larger clinic purchased at $6,700,000. The smaller clinic purchased at $3,750,000, with the smaller clinic carrying the previous debt of $2,700,000. Therefore, the larger clinic, by carrying no debt, makes it eligible to be transferred into her charitable remainder trust. Marianne also chose to keep $1 million from the sale called boot. The balance of the transaction went to the realtor commissions and professional fees. Marianne then gifted the larger clinic to her charitable remainder trust, this giving her a tax deduction of approximately $2 million to be used the first year and carried forward for the next 5 if she couldn't use it all. The property had a low tax basis, but because the trust is tax exempt, there is no tax on recapture of depreciation or capital gains when sold within the charitable trust, and the 100% of the $6.7 million proceeds when sold were reinvested. This was Marianne's story before. Her building was not generating the income she wanted and was very stressful for all the 8 reasons listed here. The fundamental truth, the property had outlived its benefit. Her story after, however, the charitable trust is giving her an income of 8% each year based on the value of the trust each year for life, with the first year paying her $535,000 plus. The smaller clinic in income of $220,000 plus, paying down the debt, but giving her $32,484 net to Marianne. Marianne doubled her income, and as noted earlier, she received $1 million from the sale for her personal needs and wants. Marianne also set up a donor-advised fund that will someday inherit her charitable remainder trust. The donor-advised fund will be run by her 3 children and then carried on by her grandchildren to fund the charities that she and her family cares about. She has fostered family unity and cemented her family legacy. In conclusion, Marianne doubled her income, received $1 million on the transfer, diversified her investment, she mitigated her taxes, avoided capital gains, reduced her estate tax, received tax deductions, received income for life, protected the asset in the charitable remainder trust from creditors and lawsuits, fostered family unity, and cemented her legacy. Estate tax-wise charitable planning can be used and benefited in many ways. For more information on this or any of our other presentations, contact Adams Hanson and Associates or the attorney or CPA you received this from.